Hello, everyone. Thank you so much for joining us again for another episode of Safe Money Radio. You might be listening on the radio. You might be watching online on YouTube and watching the podcast. So if you are a radio listener right now, just know you can go to YouTube and you can watch today's episode because we have a guest. So you'll actually be able to view, which is nice to be able to pause and rewind, because I will tell you that on today's show, we're going to be dealing with some very, very important stuff, critically important stuff to your retirement planning. But it is so confusing, which is why I have a guest IRA expert on the show with us today, actually from the Ed Slott Group, Andy Ives. Thank you so much for joining us today.
Yes, very happy to be here. Appreciate the invite.
So I was telling Andy before we started, he's a first-time guest on the show, but I know I'm going to have him on again and again. And those of you that have the benefit and the blessing of listening to him today, you'll learn very quickly. He's one of the best when it comes to understanding all this IRA and 401k and QCD and RMD stuff. And so he makes it simple, and it's really, really confusing, which is why I have to spend so much time going and sitting at their feet and studying and drilling down on all of our modules and our books. And so, Andy, if you will, tell us a little bit about yourself and what it is that you do in this crazy world of ours.
All right. Well, as I mentioned these numbers, I start to feel a little bit old. I'm coming up on 30 years of experience in the industry. I started out back in the 90s as an IRA customer service representative. But then from there, I did a bunch of different things, from wholesaling mutual funds. I sold 401k plans direct to businesses. So I would meet with some of the, the machine shops as well as the corner office law firms. I worked as a third-party administrator for a bit. But sales really never did it for me. So probably about 7 years ago, I decided to make a change, get into more of an educational and helping, assisting advisors position. And that led me to Ed Slott. So it gives me the chance to write, to teach, and to really just, help people that are in need when it comes to anything IRA or retirement plan related.
Well, I and many other advisors like myself are so glad that's what you did, because having you here, and Andy knows this, having access to him to be able to email or text or call and say, hey, I've come across one today that I've never come across. And a lot of times it's just me saying, I know I should know this, but stuff is so confusing. It's so easy. And we go over it over and over and over again. And sometimes it's the easiest answer that I'm like, is it really that easy? And then I'll think, I just got to check. I've got to ask Andy or Sarah or Ed and find out what's going on with this. So, hey, we're grateful that you're with us. Now, you're actually a CFP, correct?
Yeah. It was one of the best things I did. I was meeting with so many different advisors that had all these designations after their names. I said, this is a bunch of years ago. I said, I need to get some letters after my name.
Yeah.
But it's a tough program. It took me a couple of years to get through it, but man, it sure does expose you to a lot of different things. It's a bear of a program, but I'm proud of that CFP.
Well, we're glad to have you here, your expert knowledge and background, your 30 years of experience. And so I just want to say this as we get started. I want to steal a little bit of time from this segment for our remaining segments and just say, friends, if you're listening and you want to know more about what we're talking about on the show, you can always call in. Our good friend Ed Slott has written a new book, The Retirement Savings Time Bomb Ticks Louder. And we've had him on the show talking about this. I actually was in person when they handed out the very first copies of the book, and I was the second person to get one, almost the first. I was right there on the front row. And we talk about the stuff in this book all the time. We're going to be referencing stuff that's in this book all throughout today. And so you can always go to Amazon and order the book. You can always call us in and come in for a free consultation. I have copies of Ed's book. I give away copies of my book that Ed wrote the forward for free. And so call us anytime. Our number is 866-780-SAFE. That's 866-780-7233. And there's always someone standing by to take your call. Okay, friends, if you're just now joining us on the show, we have a great guest advisor with us on the show today. He has a CFP. He works with the Ed Slott Group. He has over 30 years of experience in this industry. And Andy, here's what I want to do to start off with. I realize that there's so many confusing terms when it comes to IRAs and 401ks and all this stuff. And one of the most beneficial things that an IRA owner can do is make use of something called a QCD, a qualified charitable distribution. We talk about it a lot on this show, but this is especially helpful once a client reaches RMD age, even though they can start at 70 and a half, but it's really helpful. But it seems to trip up advisors, clients, consumers. I even see people write some things that I'm like, no, that's not true. Be careful. So walk us through some of this confusing world of QCDs, what they are and how they work.
Yeah, for sure. Yeah, qualified charitable distributions are very popular. It's a way for anybody that's charitably inclined to get money from their IRA to a charity. But there's rules that you have to follow. Not anybody can just say, I want to do a QCD.
Right.
Like, for example, the foundational rule is you have to be 70 and a half years old. And it's not good enough to be turning 70 and a half later in the year. You have to actually be 70 and a half to do a QCD. Also, I mentioned it goes from an IRA. QCDs can only be done from IRAs. You can't do a QCD from like a 401k plan. So
Right.
Again, if you try to do a QCD from a 401k, it's not going to work. There's a bunch of different rules as far as the charity it's going to go to. It's got to be a qualifying charity. You can't do a QCD to a donor advised fund. That's a popular question. So no DAFs, donor advised funds, when it comes to QCDs. So those are some of the three main bullet points. I'm sure we can get into some weeds on some other ones, but that'll at least get it started here.
Yeah, let me ask you this, because I know I was talking with clients yesterday, and they're the kind of clients you love. They're coming in, they've read my book, they've now read Ed's book. I gave them a copy of the one we just showed, the Retirement Savings Time Bomb Ticks Louder. They've read one of Tom Hegnup's books, they've read one of Cheryl Moore's books. They're like trying to get all this information in their head. And it's perfect because they're about 6 to 7 years away from retirement. Now, this is a doctor, has done really, really well, has millions of dollars in his 401k plan, and they're starting to understand, hey, we've got some problems coming down the road. We didn't realize all this is not our money. Part of this is Uncle Sam's, and he may be a majority owner, like Ed will say. And here's what's really interesting, and this is very common if you're listening right now. You know, the doctor is working constantly and doing all the things he's doing in the world of medicine. He doesn't have time to read and study all this stuff. He's really relying on his spouse. She's the one like just devouring all this information. As soon as I can give her a book, she reads another one. But here's one of the things that came up. So I want to start with this easy yet very complex topic. She got confused about the RMD and the QCD because she said, well, now isn't the RMD 70 and a half? And I said, of course, yes. And 72 and 73 and 75. It depends on when you were born. And so she's like, wait, so you can do a QCD at 70 and a half, but your RMD may not be till 73. Yes. So talk about, Andy, some of these confusing rules and how those things work together.
Yeah, the IRA rules are nuts. So you might have 4 rules over here and 4 rules over here, and they all come together. So that's what we have is this overlap of QCD rules and required minimum distribution rules. So I did mention that QCDs can be done at 70 and a half. Back in the day, just a few years ago, the RMD age was 70 and a half. So those things lined up nicely. But once the Secure Act came along and Secure 2.0, they're pushing that RMD age later and later. So it went to 72. Then the RMD went to 73, which is where it is now. It will go to 75 in a few years from now. But right now it's at 73. Right. But they didn't change the QCD age of 70 and a half. So it's a bit of an anomaly where you can do a QCD before your RMD age.
Yeah. I always wonder where all these halves come from. You know, there's the big age 59 and a half to avoid the 10% penalties and distribution rules. And there's 70 and a half. Why does Congress always have to throw these things in here? But people listen and they read, and I have people that will call me and say, hey, my 59 and a half birthday is March 3rd, and I want to come in on March 4th, because they know you can't do it before. You got to wait till the day of, the day after. And so same thing is true on age 70 and a half. Have to be 70 and a half before you can do a QCD. It must come from an IRA, and it can work in a very beautiful way with RMDs, required minimum distributions. And that's what we're going to be talking more about on the show today. So if you want to keep up with this stuff, and I will tell you why it's important. Like I was talking about this family before, this doctor and his spouse. Here's the thing. They understand as they started to learn about Roth conversions. He's got all this tax-deferred money in this plan. And he's like, we want to do some Roth conversions. I said, great. Do you know about the 5-year rule? And like, 5-year rule? What 5-year rule? So like Andy was saying, every single rule with an IRA has another rule that goes with it. You want to do a Roth conversion? Great. But there are rules you have to follow once you do a Roth conversion before you can take qualified distributions out. So if this stuff is confusing to you, and if you're listening right now and your head's spinning, that's okay. It's spinning for a lot of the financial professionals that have to study the stuff too. That's why we have to drill down over and over and over again with people like Andy to make sure we keep all this stuff straight, because it's always changing. So we'll give you our number, 866-780-SAFE. That's 866-780-7233. Just call us anytime. Ask for a free financial consultation. We'll look at your current situation, what's going on in your portfolio, in your life, what your age is, when you plan to retire. And we are retirement income certified professionals through the American College, and we will help you understand how to develop the best plan for you and for your family. 866-780-7233. We'll be back right after this break. Okay, friends, thank you for joining us today. I have CFP Andy Ives on the show with us today. And Andy, how long have you been working with the Ed Slott Group as a technical consultant?
About 6 or 7 years now.
Yeah. So I'll say this. I've been in the Ed Slott Group 15 years now. It's hard to believe that time has flown by that quickly. It's the greatest thing I ever did for my business in the early days, is making sure I was aligned with people like Andy. And there's been a lot of people in his role over the years. And I'll just say this. He's the best there is when it comes to trying to understand something and take something very difficult and make it easy. I'm like, okay, got to call Andy. He'll be the one that makes sense out of all this to me. So I don't know how many emails I have. I've sent him some tricky stuff, even a couple of times where he said, I don't think I've ever come across this. And I think I'm the world's luckiest person when it comes to dealing with things that I didn't think existed, that we've never seen before. And I get these cases, but that's why you got to have someone like Andy around. So Andy, thank you again so much for being on the show. We're grateful.
Appreciate it. And I come from a whole family of educators, so I'm not surprised that I ended up going in this direction.
Yeah, awesome. Well, that's what we love to do on this show, is teach. I have a degree in education, and I have been doing Safe Money Radio for 15 years now. So we are just very consumer friendly. We want the right information in the hands of the consumers, because as Ed says, it's kind of his passion to make sure that they know what other people don't know. And he will say that only 1% of all financial professionals know the stuff that we talk about. So that's kind of overwhelming. But we want to jump into another part of this now, where we're talking about earlier in the show, QCDs, a qualified charitable distribution, and how that works with an IRA, an individual retirement arrangement, because you have an arrangement with Uncle Sam when you own an IRA. And so IRAs, QCDs, RMDs, it can be super confusing. So here's what I want to do, Andy. I want to read something that you wrote recently in an article, and I think an Ed Slott report. And this is what you said about QCDs. A popular recommendation is to execute a QCD early in the year to avoid any conflict with the first dollars out rule. The first dollars withdrawn from an IRA are deemed to count toward the RMD. Once an RMD is taken, it cannot be retroactively offset with a later QCD. Hence the advice to do QCDs early to avoid this mistake. Now, I say all that to say, we're recording this during the holidays. Purposely, we want this to air the first week of January. Some of you might see it online during Christmas, but we purposely are going to put this information out right at the beginning of 2025. And here's why. We want you to understand what Andy's about to talk about. QCDs and RMDs, and not getting the timing messed up on that. So Andy, try to explain this very confusing topic to our listeners.
Okay, yeah. So a couple of foundational things first. In 2025, the limit for QCDs is $108,000. So it's not unlimited. 108 grand is the cap. So we know that. Also, you are not limited to your RMD amount. So hypothetically, let's say a person has an RMD of $50,000, their QCD amount is not limited to that. You can always go to the cap of 108 if you want to. So let's get that out of the way. As far as timing, let's use that $50,000 RMD example again. If a person wants to basically send that entire $50,000 to a charity or a number of different charities via QCD, they certainly can do so. That will eliminate that income from their income, so they can just send it as to the charity, and they will not have to pay taxes on it. We suggest doing it early because, as I said in that article, the first dollars that come out of an IRA are deemed to count towards the RMD. Anything that comes out, that's going to start to cut away at that $50,000 RMD.
Okay.
If a person were to, let's say, take out, $10,000 in early January to help pay the credit card bills from the previous holiday season, they can do that, but that will be taxable income to them. Later in February, they can't say, I took 10 grand out back in January. Let me go ahead and do a QCD to somehow offset that income. Right. No can do. Once it's out and paid to you, it is taxable income. And that is really the crux of why we say do it early. Get the QCD done, get it to the charity, then anything else you take, that's basically allowable. It's just another distribution that's going to be and be taxable, but at least you haven't missed the opportunity to offset your entire RMD, or at least a big portion of it, with a QCD.
So I think that's a great example to share. Maybe our listeners right now, we like to set up automatic required minimum distributions for our clients so that they don't forget them. Obviously, they don't want to have to calculate it and keep up with it. We do it as a courtesy for them to help. But there's a two-sided, a double-edged sword on this, if you will. So here's one line of thinking. Let's set up the RMD for December as a distribution in case you don't need the distributions. If you don't need the distributions as income, let's let that draw interest all year long. And then let's take it out in December when its taxes are due, real estate taxes, property taxes, Christmas presents, all these great things. But, or however, if you're charitably inclined and you're giving money away, you have got to make use of the QCD first early in the year. So that's a good thing. That's a perfect setup, having the RMD for December and taking the QCD early. But what if that is reversed? What if you've never had QCDs on your radar and you automatically had your RMD coming out in December because you wanted to check it off your list and make sure you don't forget? I want to take that RMD right off the bat in January. Well, great. You can do that. But as Andy's saying, isn't it, to make sure I understand, Andy, they can't check the box and take that RMD in January and then come back in October and say, oh, now I want to do a QCD to offset that RMD I took back in January.
That's right. That RMD is going to be taxable income to them, a distribution to them. Now, if let's say this person had committed to giving to a charity, they've already taken their RMD, they can still do a QCD to that charity. It'll just be an additional distribution from that account. So instead of maybe 50,000 coming out to cover their RMD, maybe they take out 60. Their 50 comes out from their RMD earlier in the year. That's going to be taxable to them because they didn't think to offset it with a QCD. Then they realize that they had committed to do a $10,000 donation to a charity. So they do another distribution of 10 grand that goes directly to the charity as a QCD. They've netted out $60,000 total, but they weren't able to offset any of their RMD because they jumped the gun and took the RMD before they even talked to my good friend Brad here about QCDs and how to properly account for those dollars coming out of the IRA.
Good deal. Well, let's do this just to clarify a little bit further before we jump into the next segment. I know it confuses a lot of people and they'll say, well, I don't understand how this QCD works. Like when I take an RMD and let's say I take it as a direct distribution, I put it in the bank, and then I write a check out to my charity or to my church. I'm going to get to deduct that anyway, right? So how does the QCD even help? Why is that not really valid anymore in today's tax code, Andy?
Well, you'd have to be itemizing if you're going to take a charitable deduction. If you're not going to itemize, that's a very good point. A QCD is in addition to the standard deduction. So if you have a standard deduction, I had in 2024 was for married filing joint was $29,200. And then you have the extra standard deduction for those that are over 65. But anyways, 29 grand, if you did a QCD of just $10,000, that's $30,000 eliminated from income. Again, you do not have to be itemizing to do a QCD. If you're going to go ahead and take a distribution and then write a check to a charity, that's a charitable deduction that you'll have to itemize.
Very good. And friends, it's not that difficult. That's why we tell everyone and we ask everyone, are you charitably inclined? And they say, yes, we give to our church, we give to the Red Cross, we give it whatever it is. If it's a deemed charity, then we say, then let us help you with this. We take care of the QCD. We will set it up for you. Get the information to us about your charity, where you want it to go, how much. And you don't have to worry about all the headaches that come from it. We will walk you through taking care of the QCD and making sure you're giving the way you want to and not having to itemize and wipe the slate clean, trying to offset RMDs and taxes and all this sort of thing. It's just a much cleaner, better way to go. And I want to clarify one thing, because Andy said in this segment, for 2025, the QCD limit's 108,000, correct?
That's correct.
So we started adjusting with inflation, I guess. It was adjustable every year. However, it's 108,000 per spouse, correct?
Mm-hmm. Also correct. Yes. So if you want to, each spouse could do 108 grand if they wanted to as QCDs for the year. And that will creep up. It was 105,000 in 2024. It's adjusted for inflation. It goes up in $1,000 increments. So it bumped up $3,000 for 2025. So yes, absolutely. You can move a lot of money to charities by QCDs.
And you may be listening right now and saying, "Oh, wouldn't it be great to give away 216,000 from my IRAs that I don't need? I'm not in that boat, Brad." Well, I realize that. I understand that. But there are people who are. And why is this a big deal? Well, as happens with the saver generation, you save and you save and you save, and you think you're going to take that trip, and you think you're going to go do this, and you don't. And you build up, that builds up in the IRA account. And if all you ever do is take just the required minimum distribution, many people have millions of dollars left in their IRA, and then their estate plan is not really a great estate plan. What they're doing is passing on taxes to Uncle Sam, or they're passing on taxes to their heirs, which is going to give money to Uncle Sam. One way to get that money out of the estate is by doing qualified charitable distributions. And then it really changes the impact of what you're truly giving to your heirs. So we're going to take a quick break. We'll come back, and we've got 3 more segments we want to do, talking about QCDs and RMDs and IRAs and taxes and all this fun stuff that we've got to deal with every day. So if you're listening right now, we always want to share this information. Ed's new book, The Retirement Savings Time Bomb Ticks Louder. If you don't have a copy of that book, you need to go on Amazon and order one, because I'll tell you, it covers all the stuff that we're talking about today on the show in great detail. It is the Bible for IRAs and 401ks and tax distributions. So you can call us at 866-780-SAFE. That's 866-780-7233. There's always someone standing by to take your call. Now, friends, if you're joining us on the show today, I'll give you a heads up. If you just turn the radio on and you hear us in the middle of this, we're talking about heavier than normal topics on the show. We're talking about all these acronyms: QCDs, RMDs, IRAs. And I say this with Andy a lot of times. We do this every day. Andy's been doing this for 30 years. I've been doing this for 16 years. We can get to rolling so quickly and throwing out QCD, IRA, RMD, 401k, 403b, 457. And people are like, whoa, what in the world are you talking about? So we kind of have to take a deep breath and slow down and say, because this stuff is really, really important. And we want to share more stuff with you as consumers, listeners, even advisors who maybe have not trained in this area of, maybe they're just an investment person and they don't jump into all the IRA tax stuff. So here's what I want to do. Let's start with this. We've been talking about QCDs, qualified charitable distributions, in conjunction with RMDs, required minimum distributions. Let's dive a little deeper into one of the most confusing topics there is when you talk about IRAs, and that is RMDs, or as my clients often say, RDMs. Brad, I got to take my RDM. RMD, yep. Yeah, whatever it is. So, Andy, let's start at the very basic. What is an RMD, and why is it so confusing now that we have 4 different ages that RMDs apply to?
Okay, yeah. So the very basic rules and why RMD exists. When you put money into an IRA many years ago, you are allowed to deduct those dollars if you want to. So the government says, we'll allow you to take a deduction for that. You don't have to pay taxes if you put, 4, 5, 6, 7 grand, whatever it was that you wanted to put in back in the day. But we're going to give you that deduction now. But the rules are, ultimately, there will come a time when you have to take money out of that IRA, and that's when we're going to tax you on that. So that's what that is. You made a contribution to a traditional IRA. You took a deduction for that contribution. And now here we are 10, 15, 20, 30 years later. You are now a particular age. The IRS says now you have to start taking money out so that they can get their taxes. That's the whole purpose of an RMD, so that the government can get their taxes. And it used to be that the age to start taking those distributions was the year that you turned 70 and a half. And that was the age for many years. But over the past just 4 or 5 years, that age has changed a couple of times. It changed to 72, it changed to 73. And then in a number of years from now, it'll change to age 75.
Okay. And so it was really confusing for about 3 years for the people that were 70 and a half, that then turned 72 and fell under the new rule, which only lasted for 1 year. And then it went to 73, which we're now under. And now, for those of you listening, it's anyone born after January 1st, 1960 and later, you're going to fall under the age 75 rule, unless Congress changes it between now and then. Hopefully they don't. I hope they don't mess with these RMDs anymore.
I don't anticipate any age changes coming to the RMDs at all. I think we're locked in. We did have a couple of years there in the beginning, 2020, 21, 22, where we were trying to figure out who was what. We have gotten beyond that a little bit. I think people have settled into if they have RMDs or not. Age 73 has been in effect here now for a couple of years. So really, I'm even not even mentioning, a lot of times when I do the articles that I write, I don't even mention age 70 and a half or 72 now. It seems like most people have settled into the age 73
Yeah.
RMD age.
Absolutely. And so I guess to make it easy for people, if you fell under a certain rule and you started your RMDs, don't worry about anything. Keep doing what you're doing. Don't try to
Yes.
think about, well, what about these changes? Nope. You fall under that rule. If you started at 70 and a half, keep taking them. If you started the year you turned 72 during that 1 year, keep taking them. If you're 73 or older now or about to turn 73, that's your age. And for anyone born after 1960, it's going to be age 75. So now, Andy, I know this. Every single meeting we get together, at least twice a year, and a lot of times I'll go to the 2 days just to get the extra training. 3-4 times a year, I'm sitting in front of you and Ed and the whole team, and you're teaching us with our Bibles regarding this stuff. Why do we cover RMDs in every single meeting? This should just we should be able to cover this in a segment in 3 minutes and be done with RMDs. Why is it so confusing?
There's so many ins and outs, and that's not just the age. It's like, what accounts does it apply to? Does it apply to an inherited account? There's so many different permutations of what's going on, and it touches everybody. If you have an IRA, you will have an RMD. If you have an inherited IRA, you may have an RMD. So the fact that it's just so broad, and I've even asked that question. We've put some of the same stuff in the book in our training manuals time after time after time. And I asked one of my teammates, I said, why do we keep putting this stuff in here? And the response was perfect. It was like, how many questions do we continue to get on this stuff? I said, you're right, every single day. And it's not just just people off the street. It is advisor after advisor after advisor that asks these questions. So we just got to keep pounding it home, meeting after meeting.
Let's share one quick example. I know I'm putting you on the spot, but you know your stuff. So let's say you are 73, so you're above the RMD age for right now that says you got to take it, but you don't have any IRAs. You have a 401k and you're still at work. You're still working with an active 401k and you're 73. Do you have to take an RMD?
Do not necessarily do not. So that's a good question. So let's say I turn 73 this year. This year is my first year for taking an RMD. I do not have any IRAs, like you said, but I have a 401k, but I love my job and I'm still working. Oftentimes, 401k plans and other plans can have something called a still working exception. It's not required, it's not mandated, it's an optional feature for plans, but most plans have it. If you continue to work, you can put off taking that RMD until the year you separate from service. So if I have no IRAs, I don't have to worry about any RMDs from my IRAs. If I have a plan and I work to be 80, then 80 is my first year for taking an RMD, if that's the year that I retire.
Very good.
Now, I will say that if I did have IRAs and I did have a 401k plan and I was still working, that still working exception does not apply to my IRAs. So if I have this 401k and I'm still working, I would not have a RMD to take from my 401k because of that still working exception. I would have to take the RMD from my IRA because the still working exception doesn't apply to IRAs.
That is exactly where my next question was going. So good thinking there. You can have two scenarios where it doesn't apply to one, but it does to the other. If you have an IRA, you have to take it. If you're still working, have the 401k, you don't. But now let's tweak that. You mentioned it a little bit, but let's tweak it and say they're 73. They have a 401k, still working exception applies, but they retire. Let's make it difficult. They retire on December 15th of that year.
Yes.
Do they have an RMD to take now?
They do. And I've seen it before. I've seen a situation where a person was still working at their company. They had a 401k. They said they did not have an RMD, and they were right. And they planned to work for many more years. And during the year, they did a rollover. They rolled some of their 401k over into their IRA, which they're certainly allowed to do. But then in your scenario, something happens. Maybe the company falls apart. Maybe they get injured, and they end up leaving on December 15th.
Yeah.
Now they have separated from service in that year, which means the RMD applies in that year. And in that scenario where they already rolled over money, strangely enough, by leaving on the 15th of December, retroactively, they've got a problem. They rolled over their RMD because the RMD now applies for that year. The still working exception, you have to work for the entire year. For the still working exception to offset an RMD for a particular year in a 401k, you have to, it's not good enough to retire after your going away party at 5 o'clock on December 31st. You got to
Yes.
set your retirement for January 1.
That, friends, I've said this many times on the show. If you've listened, I've said, please help us out, help yourself out. So many people naturally retire on December 31st. And like Andy said, maybe it's 5 o'clock on December 31st. But depending upon your age and your situation, that can be a terrible decision. Wait until January the 1st for your retirement date. It can set off and trigger so many different taxable situations, RMD problems, this sort of thing. So how do you take an RMD on December the 31st after 5 o'clock before January 1? It's an interesting situation. So don't do it. Stay away from it. Make sure, here's what we always say on the show. Make sure you're talking to a qualified financial professional who knows all this stuff inside and out. And I'm going to tell you, if you think your average person on every street corner who just sells stocks, bonds, mutual funds, and that's all they do is they know all this stuff, they do not know this stuff. They don't even want to wrap their mind around this stuff. So they're just an investment person, and that's okay. For many, many, many years of my father's career, that's all he was. And then here's what happened. Here's what changed. He reached retirement age. And when he reached retirement age and all these rules started applying to him, he's like, I don't know any of this stuff. And so he was coming to me, asking me, saying, I just never dealt with that side of it. When you have to deal with the reality of it's when it will become very, very important to you. That's why we want to be proactive. We want to be thinking about the future, not today. What's going to happen on down the road with RMDs, with QCDs, with taxes, with Roth conversions, and how many years you have to wait before you can take distributions and all this fun stuff. So hopefully your head's spinning a little bit right now. That means you're learning something new. We're going to take a break so you can breathe for a minute. I'll give you a phone number so you can call in anytime. Ask for our free information. You can ask for a copy of my book, Bulletproof, the Safe and Secure Retirement Income Plan. You can also come in and meet with us. I'll give you a copy of Ed's book, The Retirement Savings Time Bomb Ticks Louder. This stuff drills down on all this stuff. Our number is 866-780-7233, 866-780-SAFE. Call us anytime. Friends, if you're just joining us, we've got 2 segments left. We're going to jump into kind of some heavy stuff here, but it's stuff that you absolutely need to know. So guest IRA expert, 30 years of experience, CFP, Andy Ives is on the show with us today. Andy, let's talk about one of the funnest topics that exists to me. That's when someone dies, when an IRA owner dies. That's when all the fun stuff starts. I mentioned this to Ed in our last meeting together. And when I said, let's talk about, he said, don't do it, Brad. Don't do it. Don't go there. You don't want to know what happens when an IRA owner dies. So let's do this. Just how confusing can this topic of RMDs be once the IRA owner dies? There's so many different types of beneficiaries now. So let's just talk about it a little bit. Jump in there and make some head spin.
Well, we have a number of different charts that we share with our advisors. And one of the charts is we call our gold chart. And the gold chart is because that's the color of it that we chose for it. But it's a 1-page chart, and it just breaks down the different classes of beneficiary types. There's 3 different types of beneficiaries. There's not a whole lot of words on that chart compared to our other charts.
Right.
I tell people all the time, I could literally do a half to a full day presentation if I simply walked in the room with that one chart.
Yeah.
There are so many permutations and differences between the different types of beneficiaries and what rules apply to them. It is astounding. It's almost shameful, to be honest with you. Whether you are an eligible designated beneficiary, a non-eligible designated beneficiary, a non-person beneficiary, as I like to call these people. So many different rules there, types of beneficiaries. Once you identify, it's just a flow chart. When did the person die, first off, because we have rules before the Secure Act and after the Secure Act. Mm-hmm. What type of beneficiary are we talking about? Once we identify the type of beneficiary, how old was the person when they passed away? It's just one thing after the next. There is an answer at the end of every maze. You just have to know what turns to take.
And am I correct in that this stuff has been so confusing that even Congress has had to revisit what the definition means, who falls into this bucket, that it's taken them some time to actually iron all this stuff out?
Yeah, so they had to. To give you an example, like a minor beneficiary, there was at the beginning it was like age of majority for every different state. No, that was cleaned up. Then they said made it age 21. What constitutes a minor? What constitutes a disabled person? What constitutes a disabled minor? Some of this information literally just came out a couple of months ago. They said what the rules were back in 2020 with the Secure Act. finally, here we are a number of years later where they have clarified some of this stuff.
4 years to figure some of this stuff out. So if you don't think it's not confusing, it's super confusing. So you mentioned 3 different types of beneficiaries and how you could do an entire day seminar. I know you could do a week on it. It's just so confusing, and we're only in
Right.
one 5-minute segment here. So just real quick, give us an example of who is the only beneficiary who can roll over someone's IRA to their own IRA.
Very good. So that would be a spouse beneficiary. So I mentioned that chart that we have, and there's a particular class of beneficiary called an eligible designated beneficiary, or EDBs for short.
Yes.
That includes spouses, minor children of the account owner, can't be a grandchild. A lot of people get tripped up there. They say, my grandchild is a minor. No deal. It has to be a minor child of the account owner. Disabled people, chronically ill people, and another weird category, those people not more than 10 years younger. So I don't want to get into the weeds on that one, but as far as your question goes, a spouse beneficiary is the only person that if they inherit an IRA or a Roth IRA from their spouse, they can then move that money into their own account. They are not required to maintain an inherited IRA.
And just to show you listeners how confusing this can be and how difficult, here's a very common question. I get a phone call from someone that's listened on the radio or has read my book or has seen a billboard or for whatever reason, they call in and they're like, hey, I know you're the person I need to talk to. My spouse has died. I need to know, should I roll it over into my name or not? Do I leave it in their name? Do I roll it into my name? The answer is, it depends. How old
That's
are
right.
you? You know, I mean, obviously, if you do a rollover into your own, make it your own and you're 55, well, then what's happened, Andy? If they do a rollover and they're 55, what happens?
Yeah, so that's the perfect question to ask is how old are you? If 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 I'm a 55-year-old spouse and my spouse who's 55 has just passed away, it doesn't matter how old they were. Let's just say we're the same age.
Yeah.
If I need access to those dollars for whatever reason, I want to keep an inherited IRA. If I do a spousal rollover, like Brad mentioned, and I put those dollars into my name, it's like they've been my dollars, my IRA all along. And we know that you cannot take a withdrawal from your IRA without a 10% penalty until you're 59 and a half, unless some other exception applies. So if no exception applies, if I jump the gun and put everything into my name, but I need the money, I've just stuck myself with a 10% penalty from any distribution that I take. So Brad is wise to ask that question, how old are you? If you're only 55, you can do an inherited IRA, and it's just the way the account is set up. The surviving spouse will do an inherited IRA. They can then dip into that account at any time without a 10% penalty. And then guess what? In 4.5 years, when they're 59 and a half, at that point, if they want to, they are welcome to do a spousal rollover and combine the accounts into their own.
Which often makes it much easier. And I get that, because when you leave it in the name of the decedent, an IRA may be the name John Smith, IRA, FBO, Mary Smith, deceased 12/31/2024, whatever it is. It gets very confusing, and I understand that. Yes, it's easier and cleaner to roll it over into your own name if you've already reached age 59 and a half. If not, there's reasons why not to do that. And there are other reasons why it would be if you're older, and we don't have time to get into all of it, but let's say your spouse was 74 and you're 64. Absolutely. In most cases, roll it over into your name immediately, because you won't have to take required minimum distributions once you've rolled that over into your own name, which you would have continued to take them had you left it in the name of the decedent, correct?
Absolutely, absolutely. And we actually have a real life case in one of our training manuals where a younger spouse did a rollover. Her older spouse died. She was only like 56, 57, whatever it was. Rolled a big chunk of money into her name, and then took $1 million distribution. She basically stuck herself with $100,000 penalty. Had she simply done an inherited IRA, could have avoided that.
So there's an old saying about ignorance is bliss, and I've said this forever. It is not. It is a total, complete fallacy, a lie. Ignorance is not bliss. Andy just told you. Ignorance is painful. Ignorance could be $100,000 penalty to the IRS. Ignorance about your health, about eating, about IRAs, about whatever. It's not a beautiful thing. So make sure.
It can be expensive. Ignorance can be expensive. That's for sure.
it can be very expensive. So friends, I know we went a little bit long on this segment, but that's because there is so much confusion regarding RMDs, IRAs, QCDs, the distribution rules, what happens when an IRA owner dies, all the different sets of beneficiaries. We keep up with this stuff for you. We know that this is not what the average consumer wants to spend their time doing at night. They don't want to go study this stuff and learn all of it. That's why we're here. Call us anytime, 866-780-SAFE. That's 866-780-7233. We'll be back after this break with one more segment. Well, friends, if you're listening, you know, we've covered a lot of heavy, deep, detailed stuff, but honestly, we've just scratched the surface. Like Andy and I, we understand this is very, very like level 1 on stuff that goes to level 100. But we want to get the information to you because it's information that you need. It's stuff that you're going to deal with every single day. And the fun thing about life is life doesn't warn you before things happen. I had 3 things happen this morning that I was not planning on, one of which our internet continued to go down. It's never gone down ever, but it kept going down over and over again while Andy and I are trying to put this information together for you. Other things happen constantly. Life throws you curveballs, and that's when you have to deal with immediately. Well, what was the age of the owner of that IRA? Am I married or not married? Is my beneficiary more than 10 years younger than me? Have they passed the required beginning date, the RBD? All these things come into play when it's tax deferred money. So that brings us to our last segment. A lot of people know this buzzword right now, Roth conversion, Roth IRA. How do I get the money out of this plan? Because when I was younger, you know, Andy, we all deal with this. When we're younger, we're told to sign up for the 401k and get the company match, and we do it. And time flies, like you said earlier today, 30 years is gone. And now you're like, oh man, I've built this huge retirement account for myself and Uncle Sam. And he gets to tell me when I have to take it out and how much he gets to keep. And so people don't like that when they realize that, and they're interested in doing Roth conversions and maybe getting rid of some of the taxes now. But there are some pretty specific rules that go with Roth conversions. And so why do you think it's important for someone to consider a Roth conversion well before they retire instead of trying to tackle that after they retire?
Well, once again, I think I did this earlier on where I was talking to the combination of rules. We were talking about QCDs and RMDs, and now we're going to add Roth conversions to this, and the timing of these things and the sequencing. Certainly, we've all, Ed included, loves Roth IRAs. It's tax-free money. As you said, the IRS doesn't own, Uncle Sam doesn't own any part of that account. But as you do your conversions, that's great. You know, there's a bunch of different conversion strategies. That is another entire webinar that you could do about Roth conversion strategies. But as you get older in life, you start to bump up against the RMD age. Mm-hmm. As we said, age 70.5 for a while, now 73. RMDs cannot be converted. We talked about earlier about how the first dollars out of an IRA are deemed to count towards the RMD. So if you want to do Roth conversions and you are subject to RMDs on your IRA, let's say, you have to take the RMD first. So if your RMD is $50,000, take it, do a QCD for it, whatever you want to do to satisfy that RMD, then you can start doing Roth conversions. If we want to bring this back full circle, if you want to minimize your taxes for the year and you have an RMD responsibility, you could do a QCD for that RMD that eliminates that income. And then once that's satisfied, you can start doing your Roth conversions. That will be taxable income that you cannot eliminate. So it can a QCD can maybe help, again, offload some income to help you do more Roth conversions.
So a real life example, just thinking of it while you're sharing that example so the listener can understand. Say you've got $100,000 in your IRA and you're above the age of 73. So you have to take an RMD, but you're thinking, oh, I've got this money parked over here and interest rates aren't great. I'm not making a lot. I want to convert that. I want to convert that whole $100,000 over to a Roth. What you're saying is before they can do that, they have to take out the taxable required minimum distribution portion from that account before they can convert what remains, correct?
That's exactly right. That's exactly right. You have to take an RMD. An RMD cannot be converted. You owe, as we talked about earlier, you owe the taxes on that, and you can't put it into a Roth IRA to grow tax-free. So you got to take it first.
And that's why many people, as they're savvy in their planning, say, okay, I understand that now, but I want to convert the rest because going forward, there are no RMDs. You don't have to play that game anymore. Once you've satisfied all the rules that go with a Roth conversion, there's a 5-year rule, and that's another show. But once you've done that, then you can take that money out tax and penalty free, and so can your heirs. And so that's a beautiful thing. So friends, we're out of time. I know it's a lot of information, but we are going to be doing more and more of this. We're going to try the best we can to have as many great guests on the show like Andy Ives today throughout 2025, so that you can know the answers to things that other people don't know. Ignorance is not bliss. It's painful and it's expensive. So we are here to educate you. Andy, thank you so much for joining us today.
Absolutely. Very happy to be here. Thank you.
And all of you watching right now, if you need any information, if you want our help, we are retirement income certified professionals. We've been training with the Ed Slott Group for more than 15 years now. Our number is 866-780-SAFE. That's 866-780-7233. Call us anytime. We're happy to help. Have a great week. Happy holidays, a wonderful 2025, and God bless.